So take out your notes on FSC, financial statement analysis. I shared the notes, right? Yesterday. Yes, I wanted to confirm whether I had shared. I remember requesting you in our last session, kindly you print them before our class time. Eh? So that's what I want us to discuss. So now let's look at that financial statement analysis. Now, this was the topic which was added. That's what now makes financial reporting to be now financial reporting and analysis. And note that since now it's FRA, you'll never miss a question on an analysis part. That's the financial statement analysis. And financial statement analysis mostly will focus on ratio analysis. So therefore, this one will never miss. Good. So what's financial statement analysis? You see now in financial reporting, it's all about preparation of financial statement. Now the question is, once you prepare the financial statement, now how do we interpret or how do we analyze those financial statements? Now that's what you call financial statement analysis. So now let's go through that, what we have. And that financial statement analysis is the process of analyzing the company's financial statement for decision-making purposes. So you're saying that financial statement analysis is the process of analyzing the company financial statement for decision-making purposes. Yeah, why? This is because external stakeholders use it to understand the overall health of an organization, as well as to evaluate the financial performance and the business value. You see what happens? Once you prepare the financial statement, it's difficult for an accountant to understand the financial statement. But if you try to break down, for example, showing how much was the earnings per share, how much was the dividend per share, how about the liquidity aspect of the company? So in that case, now they can be able to make a viable decision. And now we have some various tools of financial statement analysis. So tools of financial statement analysis. Number one, we can use what we call the common size analysis. Common size analysis. And then number two, you can have what we call the comparative analysis. And that we have ratio analysis. Now, those are the three tools of financial statement analysis. So you have the common size analysis. And a common size analysis further is classified into two. We have what we call horizontal analysis. And then we have what we call the vertical analysis. And what's the difference between the two? Now, what happens under common size analysis, it's all about identification of what we call the base case. The base case can be either an element or a period. That's the year. So under horizontal analysis, almost it's also known as the trend analysis. When you take the financial statement, you want to compare. Maybe you have three periods. We have year one, year two, year three. In this case, for example, you want to evaluate the sales. Now, in this case, what happens if you're evaluating the income statement? The first financial year and analysis becomes what we call the base year. So that means when you're making the decision for year two, you compare the sales for year one against the sales for year two, you determine either the increase or the reduction. If you want now to determine for year three, So now you have to year 2 and year 3. So in this case, year 2 becomes the the base year. Now that's what we call the horizontal analysis. What about the vertical analysis? Now, under vertical analysis, it's not a must that you have to be having various periods. You can only analyze for one period. You have the income statement where you have the sales, you have the cost of sale, you have expenses, you have the gross profit, you have the net profit. So in this case, under vertical analysis, it's all about expressing all the other elements of the income statement as the base case of sales. So in this case, you hold the sale 100%. Then you ask yourself, cost of sale. If sales is 100%, what about the cost of sale? Maybe you determine 80%. Gross profit determine is 20%. So in that case, that's what you call the vertical analysis. So under vertical analysis, you can perform both for the income statement. And for the income statement, we'll hold the sales as the base case. If you're writing the balance sheet, that's the statement of financial position. Statement of financial position. The total assets will be our base case. That means you express all the other elements of the financial statement, holding the total asset to be the base case. And in case you are writing the income statement, you hold the sales to be the base case. So now let's start with the first one, the common size analysis. So under common size analysis, it's categorized into two. And number one, we have the vertical analysis. Number two, we have the horizontal analysis. Let's start with the vertical common size analysis. Now, under the vertical common size analysis, in vertical common size analysis, each account or item in the financial statement is expressed as percentage of a base case account. Can you underline that? Base case account. Base case account. And the base case account for the income statement is the sales revenue. Also underline that. The sales revenue. Yeah, in that case, every item in the income statement is expressed as percentage of sales, holding the sales revenue to be 100%. This type of analysis allows the analyst to determine how various components of the income statement affects the company's profit. And then the other point, that the base case for the statement of financial position of the balance sheet is the total asset. Can you underline that? Is the total asset. Or the total equity and liability. Remember, in the balance sheet, we have the total assets, of which the total asset should be the same as the total equity and liabilities. Good. Therefore, every item in the balance sheet will be expressed as percentage of total sales, holding the total assets to be 100%. Good. So now let's do that illustration. We have illustration 1. So this is vertical common size analysis. And so I'm doing illustration 1. And we are told that consider the following financial statement for Vibes Limited and prepare vertical common size income statement. So we have the income statement. So we have the revenue. We have the cost of sales. We also have gross profit. We have administrative expenses. We have distribution expenses. Then we have earning before interest and tax. There's also the investment income. Then we have the earnings before tax. We also have the tax expenses. And then we have the net income. So here we have 30,000. Good. So now, what was the question? Now, let's see that question again. We are told that consider the following financial statement for Airvibes Limited and prepare a vertical common size income statement. Now, we have said that under vertical common size analysis, you need to identify the base case. They've said that for the income statement, the base case will be what? Yeah, the base case is the sales. So you hold the sales to be 100%. Then you express all the other elements as percentage of sales. So this is what you are doing. For example, for the cost of sale, you see that if 30,000 is equivalent to 100, what about 12,000? It will be equivalent to how much? So do that. So in short, you'll be taking 12 over 30 times 100. So it says that if that is equals to 100%, what about 12,000? So you'll take 12, you divide by 30, then you multiply by 100. You get an amount of? Yeah, it's 40%. We do the same for gross profit. Now, gross profit, you take 18, you divide by 30. That means it will be an amount of 60%. What about admin expenses? You take 1.5, you divide by 30 times 100, you get 5%. You take 1.2, you divide by 30, you have 4%. 15.3 divided by 30, 51. 51, 51%. 0.5 divided by 30. Sorry? 1.67. You take 15.8 divided by 30. Sorry? 52.6. 67%. You take 3 divided by that. That's 10%. 12.8 divided by 30. You get? What 1 point? Yeah, 41.67%. As simple as that. So now, how can you interpret that? Now, when you're interpreting, we have the three major elements you factor. One being the gross profit. The last one is? Sorry? Oh, 12.8. You get? 2.67. So one of the elements you factor is the gross profit. Also, you look at the earning of the operating profit. Now, operating profit is the profit before tax. Operating profit, which is the earning before interest and tax, and then the net profit. Those are the key elements you factor when you're doing the analysis. Now, for example, in this case, you can say that the gross profit was 60% of the sales. What about in terms of administration? Admin expense was 5% of the sales. Also, of all our sales revenue, 4% went into distribution expenses. Then our operating profit was 51%. This is what we call the operating profit, or the earning before interest and tax. Then here we have the gross profit. The gross profit was 60%. The operating profit was 51%. So you can say that how much was the operating cost? The operating cost, the difference between the two, which is 9% and 9%. Yeah, these are what we call the operating expenses. Then earning before the tax, that is okay. Then we have the tax. Tax, we paid 10% of our sales revenue. And then the net income for the year attributed 22.67% of our what? Of our sales. Are you together? Yeah, good. Any question before we do another illustration? Yeah, so that's what we call the income statement, vertical common size analysis. Now, I want us to do one for statement of financial position. Let's go to the other page, page 2. Now we do what we call vertical size, common size analysis. For the balance sheet statement of financial position. So let's do illustration 2. Illustration 2, we are told that consider the following financial statement for Vibes Limited and prepare vertical common size balance sheet. So we have the statement of financial position. So we have the assets. For the assets, we have the non-current assets. And the non-current assets, we have PPE. We also have intangible assets. Also, you have the investment property. And then we have the total non-current assets. And then we also have the current assets. Under the current assets, we have the inventories. We have trade receivables. Then we have cash at bank balance. Then we have the total current assets. Then we have the total assets. Then on the other part, we have the equity and liabilities. So under the equity and liabilities, we have the ordinary share capital. We have share premium. We have the retained earnings. Then we have non-current liabilities. We have 10% debentures. Then lastly, we have current liabilities. We have trade payables. Then we have bank holding. Then we have the total. So for the non-current assets, we have PPE. Have an amount of 22,000. We have 12, then we have 5. And the total non-current assets an amount of 39. And then under current assets, we have inventories, 95, 11,500, 500. And the total current asset we have is 21,500. The total assets is 6,500. Ordinary share capital is 20,000. We have 6,000. We have 11,900. 12,000. We have 64. We have 42. And the total is 6,500. So we have that information. So now let's evaluate that. We say that under statement of financial position, what will be the base case? Yeah, the base case will be the total. Yeah, total assets. And our total asset is 6,500. So we hold this one to be 100%. So you express all the other elements as percentage of the total assets. So for example, the first one, PP, will take 22. You divide by 60.5. Then you multiply by 100. You get an amount of that 6.6. That's 6.36. Then the second one, you take 12, you divide by 60.5, then you multiply by 100%. 19.8%. 5 divided by 60.5, you multiply by 100. Sorry? Then here you take that 9 divided by 60.5, then you multiply by 100. 64.5%. So you take 9.5, 6.5, 11.5. Here we have 0.5. What do you get here? 15.7%. 90, sorry? 19.03. 19%. 0.8%. What about now the total current assets? We'll take 21.5 divided by 60.5 times 100%. Sorry? That 5.5%. Now we are done with the assets. Now let's separate the equity and liability. So this one will take 20 divided by 60.5. This one will be 60.5. That 3 and that 3%. $9.9. Sorry? 19.7%. $19.8. 10.6%. Yeah, 6.9%. As simple as that. So now we have analyzed. So how do we interpret this one, the total? This one. Sorry? This is 100, eh? Yeah. Yes, it's 100%. Eh? Yeah. So in this case, actually the statement of financial position is very important when it comes to interpretation. Now, for example, you can see that holding the total assets to be 100%, how have you distributed your assets, or how well have you diversified your portfolio? You can say that for PP, we have invested that 6.36% of the total funds together. The total fund is the same as equity and liability. What about the intangible assets? Intangible assets represent almost 20% of our total assets. Then we have investment property. What is investment property? Now, investment property, they are assets held to earn rental income or for capital acquisition. They are not used for day-to-day operation. Now, for example, if a company has a land which is held for future use, that's what we call investment property. Or in case they have a building of which they are renting out, that's what we call the investment property. But if they have the asset they are using, that's part of PPE. So for the investment property, they have invested 8.3% of the total assets. Also, you can say that the non-current assets represent 64.5% of the total assets. What about the current assets? Now, the current assets shows the liquidity position of the company. Current assets, current liability, they are the liquidity element because they're working capital element. So you can see that of the total assets, inventory represents 15.7%, Debtors represent 19%. What about in terms of cash and cash equivalents? We only hold 0.8%. And therefore, the total current assets in terms of liquidity is represents that 5.5% of our total assets. Then we have the equity element. Under the equity element, the ordinary share capital represents that 3%, share premium 9.9%, and then of all the total assets, they are being financed by retained earnings, 19.7%. Then debenture is part of it shows the gearing ratio. Yeah, the gearing, how the company has borrowed. So it's 19.8%, or in short, you can say that of all the total assets, they have been financed by a long-term debt, 19.8%. Then we have trade payable. Now, trade payable and bank overdraft, they are short-term debts. So we have 10.6, that's trade payables. And then we have bank overdraft, which represent 6.9. As simple as that. Any question? Now, can you take the last sitting question? August 2021, question 5. August 2021, question 5. August, and also that one is your assignment. August 2022, question 5. Now, part A of the question, of which that was the most failed question in that sitting. Discuss the business concept of triple bottom line as applied in financial report. We're in question number 5. Yeah, triple bottom line. Now, most of the students answered bottom-up economy. Yes, that's what you are getting. Triple bottom line. What is triple bottom line? Triple bottom line, also known as integrated reporting. Integrated reporting. And I think you have that one in your handout. So assist me with your handout. Assist me with that handout. Good. Yeah. Now, triple bottom up, this is a way of financial reporting where the elements are classified into 3. 1, you consider the financial aspect. Financial aspect. Also, you look at the environment or earth. Environment or earth. What else do you consider about the people? That's what you call integrated reporting or bottom tip line. So just needed to indicate financial aspect, environmental, people. Even without explaining, you get 8 marks. And that one is in your handout. Let me see whether you have that one in your handout. Must be having that information. Who have seen it? Is there in that my handout? I've explained that concept. Page 37, Yes, handout page 37. Handout page 37. In handout page 37, You have the triple bottom line accounting. What is that? Now, triple bottom line is an accounting framework which incorporates 3 dimensions of performance, that is social, environment, and financial. Yeah, we have the profit. Now, profit is all about the financial aspect. We have people or social, people or social, and then we have the planet or environment where the entity operates. That's what the examiner was asking. Now let's go to part B of the question. Part B of the question. Actually, 99% of the students didn't get that. So 8 marks, they are going like that. Then part B, I told that. Part B of the question. Dragon Limited is a public entity which has grown in recent years by acquiring established business entities. The director of Dragon Limited have identified 2 potential entities targeted for a takeover. The directors believe that the shareholders of the 2 target company would be receptive to a takeover. As a prerequisite to the takeover decision, the director have tasked a firm of consultants to carry out a cross-sectional analysis of the financial statement of the 2 potential target companies which operate in the same industry. The financial statement of the 2 entities as at 30th of April 2022 was follows. So you have 2 companies, Able Limited and Cedar Limited. We have the income statement, we have BS. Required. Number 1, the common size statement of profit or loss for the 2 entities. So in this case, it's not 1 company. If it's 1 company for a given period, that's what we call horizontal analysis. Now here we have 2 different companies. So if you have 2 different companies, you treat it independently. So that means you factor in what we call the vertical analysis. For the income statement, you hold it to be 100%. Then in an exam, in that scenario, you don't copy what you have. Are we together? You don't copy what we have here. You just indicate revenue, cost of sale, don't include the amount. You just compute, you just show the percentage. This is what I mean. For example, for Able, you show the revenue, Able and Cedar. Then we have the cost of sale. For example, revenue is 100%. This one is 100%, 90%, 80%. Don't go and try to show what I'm trying to do here, because in this case, you see you have 2 companies. This is what we'll be focusing on marking. Good. Then number B, the common size statement of financial position, and then you advise the director of Dragon Limited on the best company to take over. Best company to take over. I told you to the income statement, you can use the net profit. In terms of asset, actually in terms of balance sheet, it's not a must to use this one because the asset base does not determine the real good performance. So performance is all about how do you increase the earnings per share. So it will come from the income statement. Now you look at the net income. The one with the highest, you make that decision. And that's how you're getting your 20 marks. So any question on vertical common size analysis? You have a question? So now let's look at number 2, and that's the horizontal. So now let's look at number 2, horizontal common size analysis. Horizontal. Now, under horizontal analysis, each account value is expressed as percentage of designated base year account. Can you underline that? Base year account value. Base year account value. Then this allows the analyst to see how the items have changed over a given duration. Horizontal analysis is also known as trend analysis. Can you underline that? Yeah, that horizontal analysis is also known as the trend analysis. Yeah? It's also known as trend analysis. Good. In this case, for you to perform the vertical analysis, you must be having more than one financial year. And in that case, the base year becomes the first period. So now let's do that illustration. You are told that. Consider the following financial statement of Airvibes Limited and prepare horizontal common size income statement for the year 2019 and 2020. So you have that financial statement. So this is 2019, and then we have 2020. So 2020, we have 34. We have 12,500. We have 21,500. 1,200, 1,800. So in that case, how do you perform the horizontal? So that under horizontal, you hold one as a base year. So 2019 being the first financial year, this one becomes the base year. And you hold all the items for 2019 as the base value. You assign it 100%, 100%, 100%, like that. Now let's factor that for 2020. So 2020 it will be this how you argue. If 30,000 is equivalent to 100%, what about 34 will be equivalent to what? Give me that. So in short, you take 34, you divide by 30. 34, you divide by 30, then you multiply by 100%. You get? 113.3. Cost of sales. If 12,000 is equivalent to 100, what about 12,500? Equivalent to what? So take 12.5 divided by 12. Sorry? 0.17. Gross profit, 18,000 is equivalent to 100%. What about 21,500 is equivalent to? $119.4%. So let's do that. Sorry? 80%. 150. 150%. $120.9. 40%. 118.4%. 133.33%. And lastly, the net income. 113.14.8. As simple as that. Now, how do you interpret? As an interpreter, how do you interpret? For example, let's interpret revenue. How do you interpret the revenue? Good. Like the revenue from 2019 to 2020, there was an increment by 13.3%. What about operating profit? What about the operating profit? Operating profit had increased by Yeah, has increased by 20.9. What about net profit? Over one period has increased by how much? Yeah, 14.8%. As simple as that. Good. Now that's what we call the common size analysis, both the vertical and horizontal analysis. So you can look at that for 1 minute, then we come to do the other one, comparative financial statement. Now let's look at our second method. That is comparative statement analysis. Comparative statement analysis. So comparative statement analysis deals with the comparison of different items in profit or loss account and the balance sheet of two or more periods. So in short, for comparative, you are comparing two things. For example, you might be comparing 2019 and 2020, the way you're doing here. But in this case, under comparative analysis, it's only concerned with the change. Right, together. You see, in this case, we have taken 113. Under comparative analysis, you only consider the change. And the change, for example, for the first element will be 13.3%. Here we have 4.1%. What about this? Negative 20 goods. Yeah. So, and we have the comparative income statement. Now, three important information are obtained from the comparative income statement. They are gross profit, operating profit, and the net profit. The change or the improvement in the profitability of the business concerned is determined over a period of time. Then to the statement of financial position, the financial condition of the business concerned can be found out by preparing the comparative balance sheet. Then the various items in the balance sheet of the two different periods are used. So now let's do that illustration. We have an illustration there. That illustration, we have two financial periods. So you're told that consider the following financial statement for Airvibes Limited and prepare comparative income statement for the year 2019 and 2020. So you have the revenue for, you have the income statement for the two period. So now let's prepare the comparative. We have 2019, we have 2020. So number one, you need to compare the absolute change. And how do we get the change? So you hold the first period or the base year to be PO, and then 2020 now will be P1. So to get the change, you take P1 minus PO. And how do we get the percentage change? To get the percentage change, you take P1 minus PO, you get the change. Once you get the change, you divide by the base case, which is PO, then you multiply by 100%. Now for change, that's what we call the absolute change. It can either be positive or negative. Now, for example, the revenue, that to 34, was it an increase or reduction? An increase by how much? 4,000. So it's plus 4,000. Here we had plus 500. Here you have plus 25. Here we have negative 300. Here we have 600. Here we have here we have minus 300. Here we have is it that 200? 29, which is an increase. And then here you have 1,000. And then here you have is it 19? Good, which is an increase. So get the absolute change. Now, once we have that, now let's get the percentage change. You take P1, PO, that's our change, 4,000. Then you divide by the base case, which is 30,000. So for example, you'll take 4, you divide by 30,000 times 100. The second one will take 500 or 0.5. you divide by the base case, which was 12, then you multiply by 100. And the first one is 13 point. The other one was 167. We have 19.44. I have negative 20%. We have 50% increase. We have 20.92, which was positive, 60% reduction. Here we had 18.35% increase, 33.33, and then we have 14.84. As simple as that. The cost of sale is how much? 4.16. 4.16. Good. Then I provided, now let's go back to our notes. We have the advantages of common size or comparative analysis. Yeah, also I've given the limitation, of which they are the same. They are similar to advantages of ratio analysis. Now, what are some of the advantages of ratio analysis for those taking financial management? That was our first topic, financial statement analysis. You see, one of the disadvantages, or one of the disadvantages. What are the disadvantages using this method? One is that we're using accounting data, which are prone to manipulation, right? Yeah, if you manipulate the financial statement, for example, this was correct, 30. But in this case, the manager is based on a bonus. So instead of 34, he decides to overfreight, maybe to 40,000 to be offset against the next financial year. So that means you'll have a higher increase. A higher increase as a decision maker. So you make a decision based on the sales. Yeah, so that means that's one of the disadvantages. It uses accounting data, which are prone to manipulation. Then number 2 does not take into account the time value of money. Number 3 does not take into account the inflation. Number 4 does not take into account the qualitative aspect of the business, such as goodwill, all that. So you have them in your notes. Good. So now let's look at the third tool, which was the financial ratios. Financial ratios. Financial ratios. And ratios can be categorized into 5 categories as follows. So you need to get those formulas. Categories of ratios, financial ratios. Number 1, we have investors. One, we have investors or valuation ratio. And then number 2, we have liquidity ratio. We have gearing or leverage ratio. We also have profitability ratio. And then we have number 5, asset utilization or turnover or efficiency ratios. Those are the 5 categories of ratios, where the investors ratio shows the ratio which shows the value of the company, such as earnings per share, dividend per share. We have, what else do we have? The price earning ratio, all that. Then we have liquidity ratio, shows how the company, the ability of the company to clear short-term liability within a given period of time. Then we have the gearing ratio or leverage ratio. They show the extent to which the company have used the borrowed fund in the capital structure. Profitability ratio, that one you know what it shows. Then number 5, we have asset utilization. or turnover ratio. Their ratio which shows how the company they utilize their assets. How efficient does the company utilize their assets? So now let's start with the first one. The first one, investors or valuation ratio. And these are ratios which are used to determine the value of the company. And they include, number one, we have the earnings per share. Number two, we have dividends per share. Number three, we have the earning yields. So how do we get the earning yield? We have earnings yield, we have the dividend yield. So to get the earnings yield, you take the earnings per share into proportion to the market price per share. It shows the amount of earnings for every amount invested. If you invest 1 shilling, so how much do you get back from that earnings? Then dividend yield is dividend per share into proportion to the market price per share. Then we have dividend payout ratio. Then you also have dividend cover. Dividend cover shows the number of times the dividend can be paid out of the earnings. So therefore, we'll be taking the earnings per share over dividends per share. And then lastly, we have the price earning ratio. So how do we get the price earning ratio? So to get the price earning ratio, you take the market price per share, you divide by the earnings per share. Now let's do that illustration. Do illustration one. Illustration one. You are told that the Avirex Limited share has a nominal value of 80 shillings. Yeah, nominal value is the same as par value. Yeah, so the par value or nominal value of the share is 80 shillings. The company pays 10% of the nominal value of the share as dividend for the year. So the dividend per share, they pay 10% of the nominal value as the dividend. So we multiply by 80. So that means the dividend per share is 8. The current market price per share is 160. Market price per share is 160 with a 15% earning yield. So earning yield is 15%. Required. Number one is earnings per share. So how do we get earnings per share? Now to get the earnings per share, you usually take the total earnings you divide by the number of shares. Total earnings divided by number of shares. But in this case, we're not given the total earnings. Also, we're not given the number of what? Shares. But we have earnings yield. So how do we get the earnings yield? Yeah, it's earnings per share divided by the market price per share. So can we be able to make the earnings per share the subject? Therefore, to get the earnings per share, you cross multiply. So you take the earnings yield, you multiply by the market price per share. We have our earning yield, which is 15%. You multiply by the market price per share, which is 160. 16 plus 8, you get 20. Then number 12 question. We want the dividend cover. We'll see that the dividend cover, it shows the number of times dividend can be paid out of the earnings. So therefore, it shows the number of times. So you take the earnings per share, you divide by dividend per. How much is the earnings per share? 24. You divide by the dividends per share, 8. So it's how many times? 3 times. It's saying that it shows the number of times. Then number 3, we wanted the price earning ratio. So how do we get the price earning ratio? Now to get the price earning ratio, we take the market price per share divided by the earnings per share. Market price per share, we have an amount of 160. You divide by the earnings per share. Our earnings per share is how much? Yeah, the earnings per share we have is 24. What do you get? Sorry? 6.7 times, or you can show 6.7 is to 1. As it was that. Any question? Before I look at the liquidity ratios. Good. So now let's look at liquidity ratio. Liquidity ratio. Now, these ratios indicate the ability of the company to meet its short-term financial obligation. Shows how liquid the company is. Liquid is all about being to settle the bills when they fall due. And they include, number one, we have the current ratio. We have the current ratio. How do we get the current ratio? Current asset over the current liability. And for the current ratio, the recommended ratio should be 2:1 or 2 times. That means the current asset should be twice the value of the current liability. Yeah, current ratio. Now, this indicates the number of times the current liabilities can be paid out of the current assets. And the recommended ratio is 2:1 or 2 times. Then we have the formula. Then number 2, we have the quick ratio. Number 2, we have the quick ratio or acid test ratio. Yeah, this shows how the company can be able to clear its liability using its cash and cash equivalents element, and therefore the most liquid assets. So, and how do you get the quick ratio? Now, to get the quick ratio, you take the current asset, you eliminate inventory, so that you remain with the most liquid assets. Then you divide by the current liability. And the recommended ratio is 1:1. That means they should at least be equal. So this indicates the ability of the company to meet its current liability from its most liquid current assets. And the recommended quick ratio is 1:1. So you have the formula. Yeah. Let's go to the other ratio. Number 3. Number 3, we have the cash ratio. Yeah, cash ratio. Now, cash ratio, it shows the ability of the company to create current liability from its cash and cash equivalent. What are cash and cash equivalent? Now, cash and cash equivalent, we have cash at bank account and any marketable security, such as financial asset at fair value, treasury bills, all that. So here you'll take the cash and cash equivalents. That's the cash and bank balance and the marketable securities. You divide by the current liability. Now, as you can notice that for all the liquidity ratio, the denominator we have is the current liability. Good. Now let's go to the third category of ratios. That's the gearing or the leverage or the capital structure ratio. Now, this indicates the extent to which the company has borrowed fixed return capital to finance its assets. Now, can you underline that? There's something I want you to underline. This indicates the extent to which the company has borrowed fixed return capital. Underline that. Fixed return capital. Fixed return capital to finance its assets. Yeah, the ratios include, number 1, we have the debt to equity ratio or the capital gearing ratio. Actually, under ratios, there is no understanding. It's all about getting the formula. So, it's all about getting what? The formula. Because once you know the formula, you see, the ratio is straightforward. Because if you know how to get the earning yield or the dividend yield, you know what you need. Dividend per share, the market price of per share. Nothing complicated. Because in this case, you'll be given the financial statement. So it's upon you now to extract dividend per share, market price per share. So debt to equity ratio, you'll take the long-term debt over equity times 100. Then number 2, we have the debt ratio. Debt ratio is also known as financial gearing ratio. And in that case, you take the total liability. Yeah, you see, debt to equity ratio, you are taking long-term debt. What are long-term debts? Non-current liability. Are you together? But for the debt ratio or the financial gearing ratio, you take all the liabilities. That means both the current and the non-current liability. You divide by the total assets. Then number C, we have fixed charge ratio. Now for the fixed charge ratio, how do you get that? You'll take the fixed return capital. What are fixed return capital? Or debt. Now this include debentures. That's why if you have a debenture, you have a 10% debenture. So it's fixed at the rate of 10%, or the preference shares. Also preference share, you have a 9% preference share. Now the two, if you have a loan is not part of fixed return capital. And because loan you pay on a reducing balance. But for debenture, they are always fixed. If it's a 10% debenture, you'll be paying an interest of 10% of the value. 10% preference share is 10% of the preference share value. So those are what we call the fixed return capital. Good. Then we have the interest cover ratio or times interest ratio. We have all that. Then number E, we have the equity multiplier ratio. Now, the equity multiplier ratio shows the ratio of the relationship existing between the assets and the equity. And how do you determine that? I want you to add that, to write that formula. I want you to write that formula. It's not in your notes. Yeah, we are looking at number E, equity multiplier ratio. Yeah, equity multiplier ratio. So I want you to write the formula. So how do we get this? So this will take the total assets. You divide by the equity. You multiply by 100%. That's how you get the equity ratio. Yeah. And how do we get the equity? What is equity? Equity, have ordinary share capital. We have the share premiums, as well as we have retained earnings. Have retained earnings. Yeah, that's how we determine the equity or the profitability. Then number 4, you have the profitability ratio. Now, can you go through profitability ratios? Just go through that. And then kindly for the honest student, from next class, can you identify yourself using your phone number? Identify yourself using your phone number. Yeah, the one used to register in your app. I just need to rename. Margaret umesema upitie ratios, Yes, I can see some of you are doing that. Yeah, for those who don't know how to rename, you just click participant. Then you find yourself as the first one, me. Then from there, you rename. So for example, if you are John, you just write your phone number 0705748 like that, then John. So let's do that illustration. I want us to do that illustration. And kindly, can you cram if you cannot understand this for me? Because now this one will be a mandatory question in each and every sitting. Are you together? Yes. Now we have moved from financial reporting. Now it's financial reporting and analysis. Yeah. So I don't know how you cram the ratios, but you can understand them by just doing some illustrations. But for those who are taking financial management, they have an advantage. Also for those taking FM, also FM ratio, financial ratio does not miss. If you're taking FM, you just need to have that. Because actually all the illustration we have taken for ratio analysis, I just extracted them from financial management. Actually, this is what we did in class. The exact illustration, na bado wengi wenyu wataona bado they are new things. And you did in class. Nothing has changed. Even the figures, they are the same. And then remember we said that next week we have a class on Wednesday. No, I mean a cat. Yes, and I don't miss my cat. 2 hours. What topics? I'll cover up to higher purchase. What we did last? We did higher purchase last year, so I won't include that. Yeah, all the other topic from the first topic to branches. Yes. And then next month, the first week, you also be having another cut. Eh? Yes. Sometimes I don't force my student to do the cut, but make sure you attempt my cut. Are you together? So nikikurusha hivi, I don't want hard feelings when we'll be revising that cut. Even for the online student, I'll also share with them. For the physical student, you must be here physically. Even that class I won't teach. So I'll give you time, you do the cut. It might take more than 2 hours. So it's not an out of 20, it's out of 50. So kindly don't miss that cut. And so now let's do illustration one. Illustration one. And the following are the summarized financial statement of Bonoko Limited. So we have Bonoko Limited statement of financial position, and then we have this income statement. Then under the notes, we have retained profits brought forward, a dividend paid during the year required. For each of the year, calculate. Number A is earnings per share for each of the year. So here we have two financial year. We have 2015, we have 2016. So number A, we get the earnings per share. See that, how do you get earnings per share? So you see that earnings per share, you'll take the total earnings, you just divide by the number of shares. And how do we get the total earnings? It's the same as earnings after tax. So now let's go to the financial statement. You get the earning after tax from the income statement or the profit for the year. How much was for 2015? 95, 20, and then you have an amount of 11, 660. Then you divide by the number of shares. So how do you get the number of shares? Now let's go back to the statement of financial position under the equity. Statement of financial position under the equity. So to get the number of shares, you'll take the share capital, of which the share capital, we have ordinary share capital is 99.20. You divide by the par value, and the par value is 0.25. Yeah, that means how many shares do we have? 39, 680. Yeah, and for 2 years, 2015 and 2016, they had the same share capital. So here we'll divide by 39,680, 39,680. So give me that. You get 0.23, 0.29. Good. And number B of the question. Number B of the question. As you can see in this case, this is part of financial analysis. You see, in this case, you are trying to compare the earnings per share over 2 periods with the same number of shares, but different profits. In 2015, the earnings per share was 0.23. In 2016, it was 0.29. So now, as an investor, potential investor, now you can be able to make a decision. Yeah, you look, it's not necessary that you have to look for 2 years. You can also sometimes do even for 3 years. You look how has been the trend. 0.23, 0.29, 0.34. So that means the profit of the company has been increasing systematically. So with that, you can make your own decision. Then number B, we get the dividend cover. So that to get the dividend cover, it shows the number of times dividend can be paid from the earnings. So you'll take earnings per share, you divide by dividend per share. Do we have earnings per share? How much that? It's not there, it's here. how much the earnings per share? So that's what we consider in number A. So here we have it 0.23. 0.9. Then you divide by the dividends per. How much is the dividend per share? Yeah, now you can look at your question. Let's be here. Now, to get the dividends per share, now let's go to the notes. You are given the notes. Okay, I don't mean those notes. I mean, in that question, you are given, in the same question, under the financial statement, you are given notes. Can you see the footnotes? That's what I mean. Under notes, we have the retained profits brought forward. Then you have dividends paid during the year. So we have for 2015, we have 2016. So here you paid an amount of 2240. Here you paid an amount of, but that's the total dividend. What we need is a dividend per share. So to get the dividend per share, we divide by the number of what? Yeah, the number of shares. How many shares do we have? It's here. Yeah, the number of shares. And we have an amount of 39.68. 39.68. Give me to 2 decimal places. Sorry? It can't be 56. It can't. 0.06. Around the first one? 0.06. Good. So the dividend per share is 0.06. 0.06. Therefore, how much is the dividend cover? 4.1 times. That's 4.1 times. What about this? 4.8. Yeah, the dividend cover always should be recognized the number of times because it shows the number of times the dividend can be paid from the earnings. Number C, current ratio. So that current ratio, you take current asset over current liability. Now let's go to the statement of financial position. Statement of financial position. How much is the current assets? What do you get? We have 90, not 97. You just need the current assets. 92, 447. Yeah, or you can just take the total asset, you just deduct the non-current asset, 49.95, which is the easier one. What about in 2016? 99, 615. Then you divide by the current liabilities. We have the current liabilities. And current, we have 36, 862. Here we have 42, 475. Sorry, the first one is 2.5. 2.5 is 1. What about that? Or 2.5 times 2.3 is 1. What do you say about the current asset? I mean the current ratio. Say that the recommended ratio is 2:1. Yeah, 2:1. Now tell me about the performance of this company. 2016, 2.5. Good or bad performance in terms of liquidity? Now that's what you call interpretation. There's a difference between computing the figures and interpreting. So how is the performance? That's good, right? Yes. In short, this is what it means. Our current assets are 2.5 times the current liability. So that means the performance is good. Yeah. Also in 2016, our current assets are 2.3 times over the current liability. So that shows good performance in terms of liquidity. And then number D, acid test ratio. Acid test ratio. So that under acid test ratio, you take the current assets, but you eliminate what? Yeah, you eliminate the stock, then you divide by the current liability. So it will be 92,447 You deduct the value of the inventory, which is 4145, divided by the current liability, which is 36,862. Here I'll take 99,615. You raise the inventory, which is 50,455. You divide by the current liability, which is 42,475. What do you? Na unapata ngapi? 1.2016 is 1.16 is to 1. Joyce, 1.42 is to 1. What do you say about the acid test ratio? So also known as the quick ratio. The recommended ratio is 1:1. So it's over 1. So that means we have good performance. Lastly, we have return on capital employed. Return on capital employed. How do you get the return on capital employed? Go back now to your notes. Not the footnotes, but the other notes. Look on how we get the return on capital employed. Return on capital employed is under profitability ratios. It's under profitability ratios. Yeah. It's net profit over. Yes. It's net profit divided by the net asset stroke what? The capital employed. So you'll take the net profit. The net profit is one you have the income statement, the profit for the year, or profit after tax. They had an amount of 9520. Here you had an amount of 11,616. You divide by the net assets. You already given the net asset in your 40. Yeah, 47. 40. The other one we have is 63 to 13. Then you multiply by 100%. Yeah, all the profitability ratio are expressed in percentage. Yes, as a smart student, that statement must be very important. I have said that all profitability ratios in what? I'll say that all profitability ratio should be expressed in percentage. Are you together? Yes. Then all liquidity ratio should be number of times or ratios. For example, this one, you can write 2.5 is to 1, or you can write 2.5 times. It's the same. What do you get? Sorry, 2016? Uh-huh. 18.4%. What about 2015? Yes. Good. So you can go and try question 2. We have illustration 2. I have provided together with the solution. Net asset is? Net asset was 50. This one was 50. And this is 50. So therefore you get the percentage of how much? 0.3%. Good. And that's all about that topic, financial statement analysis. Sorry? Dividend cover is 3. This one is 3.8. 3.8, eh? Good. So, and that marks the end of that topic.